Top three things. Number one, oil. Number two, deflation. And number three, the financials. First, on oil. The oil bounce last week that did not come. Don't forget what the Europeans did in the face of all this fanfare in equity markets. And again, it was only the first up week in the last four for U.S. equities in particular. But again, to the oil market, down 7.2% last week. Very much a deflationary move to down, 15.1% for the year to date, and falling again this morning with no immediate term trade support on WTI to 44.06. Now, I'd also call out that we're getting lower highs of resistance up at 46.92 is now resistance. So again, this is just not good for any oil company or any debt that is energy related. So again, watch out for that stuff. Deflation's dominoes have been nasty, and we continue to think so. That is point number two. Deflation last week was paramount. So again, the Draghi and the Kuroda, what they're trying to give you are policies to inflate asset prices. All they're really doing is giving you intermittent moves in one asset class, which is, in fact, equities going up. Now, you also have had sovereign bonds going up dramatically, but everything else has been deflating. Now, if you look at commodities last week on the week, which is the epicenter of deflationary expectations, the CRB index down 3.4% on the week. That's down 5.8% already for the year to date. So again, having a 0% asset allocation to that has not only been fruitful, but it's been very much right. Down 28% in the last 6 months has been the move in commodities. And again, that's just the upside down of what the Japanese, the Europeans, and the Canadians have done to their currencies, which I showed this morning in the early look. All three of those currencies in the last 6 months are down on the order of 14 to 18%. So again, don't confuse the weakness of those currencies that's born out of policies to inflate with U.S. dollar or economic strength. Two very, very different things. And again, hopefully you've been on the right side of that. Now, finally, on the financials, if you didn't confuse the strength in the dollar with some booming U.S. economy, and I quote the Joseph Livornia, again, that's what he called it. I didn't call it. But the U.S. economy is obviously not booming, or the financials wouldn't be going straight down. So the financials down for the year to date. If you're short the regional banks, which are down more than the XLF, they're down more than that for the year to date. Those were the top two sectors that we signaled short on last week. On the bounce, yes, markets bounce, but on the U.S. equity market bounce, we went to the financials instead of the energy stocks because there's more downside, I think, on the very immediate term to the financials than the energy stocks, even though I think both go down. And those are your top three things. We're going to have our market marathon. Again, I'm going to have some of my friends like Jim Rickards on, who's going to talk about things that are just exploding to the upside right now, like gold. We're going to talk about everything that we talk about, but we're going to talk about it throughout the day. And again, there's a lot to talk about in non-advertising central planning fan club terms, which is, of course, what we're going to do.